And hello, everyone. Welcome to our webinar today on 2022 financial reporting and tax updates. My name is Brittany Petruniak, and I'm the Director of Marketing and Communications here at Crowe. I am joined by our two presenters, Matt and Devin. And before I do our brief introductions and hop right into the presentation, I would like to begin by giving each of us a moment to acknowledge and respect the lands that we are situated on. So for myself and Devin and Matt, we are in Vancouver. So we are going to thank the Squamish, the Tsleil-Waututh, and the Musqueam people for allowing us to live and work on their unceded traditional territory. So Matt is a senior manager here in Vancouver. He brings 10 years of experience working in both public practice and in industry. He specializes in serving clients in the startup, technology, media, telecommunications, and consumer business sectors, just to name a few. And Devin, he is a partner at Crowe tax team again here in Vancouver, and he works primarily with privately held businesses spanning a variety of industries, providing Canadian corporate tax planning services, and he also advises on cross-border and international tax issues for Canadian residents and non-resident entities. So thank you both, Matt and Devin. For all of our guests, you're going to be able to interact with us through the chat and the Q&A at the bottom of your screen. So we really encourage you throughout the presentations, if you do have questions, you can submit those. Just click on that Q&A button. You'll get a dialog box, type those in, and we'll monitor and address those at the end of the session. If you have any other questions or any technical difficulties, you can also use the chat button at the bottom, and we can communicate with you that way. So a little bit about Crowe. Just so you know, we are a team of 400, and we span 8 offices across Northern and Western Canada. You've noticed the 3 of us, we're in Vancouver, but we're also in Kelowna. We're out in the Sunshine Coast here in BC, and then in Alberta and Calgary, Edmonton, and up north in the Yukon and Whitehorse, and in Yellowknife in the Northwest Territories. We are a member of Crowe Global. This is one of the top 10 accounting networks in the world. And so for you, that means you get expert advice, not only from our teams, but from those spanning across all the other continents. So we're very happy to partner with Crowe Global and be a member of this network. And then aside from your traditional audit and accounting, and tax, we also do shred. We have tax incentives and experts on hand. We can do intellectual property assessments and look at trademarks and the legality around that. We do insolvency evaluations. We have IT consulting, and that also includes getting you ready on a digital transformation for your operations. If you're looking at cybersecurity, enhancing it or introducing it, if you don't have it for your company, we have experts on hand that can do that. And then looking full-fledged in your business, succession planning. What does that look like in the future, and making sure you have the right pieces in place to be successful. So if any of these are services that you also would be interested in or need, you can connect with your Crowe advisor, and we can get you connected with our team to help you create lasting value and success for your business. So that's it for my spiel. I'm going to turn it over to our experts, both Matt and Devin, and they're going to get into what you can expect this year and some changes coming up that are going to impact your business. Matt, I'll let you take over here.
All right. Thanks for the introduction, Brittany. I'm just going to launch right into the content here. There is a lot to get through and not a lot of time. So without further ado, I'll introduce our first 3 topics. So these are changes that are going to be effective for companies with year ends starting January 1, 2021 or later. So if your company has a calendar year end, these are going to be changes that are going to be impacting you right now, because they're going to be impacting your 2021 fiscal year. Excuse me. So the first topic I'm going to be talking about are retractable or mandatorily redeemable shares. So the financial instrument standard 3856 was amended. And so this change is pretty much going to impact any entity that has ROMRS that have been issued under a tax planning arrangement. So ROMRS, they're generally preferred shares issued in connection with a tax planning arrangement. So Most commonly, this would be asset rollovers, estate freezes, etc. But they can apply to other sections of the Income Tax Act as well. So the change is pretty dramatic because for most entities that have issued ROMRS, these are going to be ending up as a liability at the redemption amount. So traditionally, most companies will have these classified in equity at par value, so fairly nominal value. So you can see how this is going to have quite a significant impact on the geography of balance sheets. So as I just said, it's going to be it's going to be fairly significant change with the adjustment to liability classification. And this will be impactful for most companies that have third-party lenders. Many financial covenants will have debt to equity ratios and things like that. So bringing a significant liability onto your balance sheet, may throw off those ratios. So we encourage all companies that have these issued to have these upfront discussions with their lenders, to either get a waiver or, in the short term, or in the long term, amend those covenants so that preferred shares are excluded from those covenant calculations. So the Accounting Standards Board, they made this change because there were a lot of sneaky Pete's that were, using ROMRS, equity classified ROMRS, where they shouldn't have been for arrangements that they weren't originally contemplated. And also, there was varying practice in when entities would recognize them as liabilities, because technically you're supposed to do that when redemption was demanded by the holders of those shares. So if you have those on your balance sheet now, I'm going to walk through the transitional provisions. So this is essentially, how you treat them if you have ROMRS on your balance sheet before the standards have become effective. So there's two scenarios here. If you have ROMRS that were issued prior to January 1, 2018, you have a little bit of leeway in keeping these as equity classified. So you would be going into liability territory if the shareholder doesn't have control at the date of transition, and also if there's a redemption schedule in place. So there's some arrangement between the shareholder and the entity that these shares are going to be redeemed at a fixed time or over a fixed period. So if you have ROMRS that were issued on or after January 1, 2018, it's a little bit more stringent. You would need to meet all of the following criteria for them to be classified as equity. So the first one is the shareholder has to have control of the enterprise before and after the shares are issued. So I'll go into some of the determinants of control, but it's not a very straightforward issue as it might otherwise seem. You can't have any consideration transferred between the parties in exchange for the ROMRS, or it only has to be shares of the enterprise. So commonly, this would be common shares exchanged from the enterprise. And then, of course, you can't have any fixed arrangement for redemption of the common shares. That also would bring you into liability territory. So you can sidestep this whole process by just making an accounting policy election to classify them as a financial liability originally. So this might be preferable for some entities that just don't want to go through the legwork, and they don't have a lender, or the lender will understand this change to their financial statements. So in restating them, there's a couple of outs that gets you out of full retrospective restatement of your preferred shares. So you can do a full retrospective restatement, and the adjustment between the par value and redemption value of those shares when you bring them on as a liability, that would be shown in opening equity for the comparative period. So commonly this would be at January 1, 2020, if you have a calendar year end. And second, you can elect to show the change in equity at the beginning of the current year. So the first year it's applied. So again, for a calendar year end, this would be 1 year forward. So January 1, 2021. So some important considerations here. You can elect to classify them as liabilities at the time of recognition, but you can't subsequently go and classify them as equity. So it's an irrevocable policy choice. If you do choose to classify them as equity and you meet all the criteria, however, there's some ongoing work that's required because you need to continually monitor your situation to make sure that there are no changes that would bring you out of that equity classification. And so here are the criteria again. You need to meet all of these criteria that we went through in order to continue classifying the shares as equity. So a few notes on control and what control means. Most people would just think of that as, okay, a shareholder owns more than 50% of the total common shares in the entity for voting purposes. So that's not necessarily the case. You'd want to look to ASPE 1591 subsidiaries. So, that has a specific definition of what constitutes control. And the standard points out, okay, here are some other determinants that you want to look at. So board representation of the various classes of shareholder, that can affect control. Provisions in the shareholder agreement that might impact or otherwise curtail voting rights of certain shareholders. And then there might be some contractual agreements in place. This would probably be less common, but it's also something to look out for. So, throughout your reporting period, if you notice any circumstances that might impact control or might impact the way in which these shares are redeemed. So, if a fixed date comes into play for when these are redeemed, that would take you back into liability territory. And so you would need to account for that in the year that happens. So a few of the determinants that the standard goes into that would change this control determination. There's of course, death of a holder of ROMRS, a change in ownership transaction. The sky is really the limit. There's any number of things that could cause you to go back into liability territory. Okay, so for liability and equity classified ROMRS, you need to include in your financial statements a description of the arrangement that gave rise to the shares. So you'd have to describe the tax planning arrangement that resulted in these shares. And specifically for liabilities, when you're recognizing them as liabilities, you'd have to show on the face of the balance sheet, okay, here's the entry to retained earnings as a result of bringing them up as a liability at the redemption amount. Okay, so our next topic here is on related party financial instruments. So there's some significant changes here. This will affect pretty much any entity that has related party transactions that involve a financial instrument. So it's pretty broadly applicable. Previously, the related party transaction standard 3840 was meant to apply to all related party transactions. With certain transactions out of scope, and then you'd reference 3856. This wasn't always applied consistently, and there was a lot of confusion among stakeholders. Hey, when do I look to 3840, and when do I look to 3856? So what's changing here is the Accounting Standards Board is saying, okay, if a financial instrument is involved in any related party transaction, then you look to 3856, and now there's some specific guidance in there on that. And so it can be an impactful change if you have a lot of related party transactions that are complex and involve financial instruments, especially if they're financial instruments that are recognized at fair value. And so again, as I was saying, you know, the reason it was changed was because there was a lot of confusion about when to apply what standard. And you know, any of us that were looking at the accounting for related party transactions probably found 3840 pretty confusing. So looking at initial, I'll just start talking about initial recognition of related party financial instruments. The changes as they relate to non-monetary related party transactions are, you know, there's not really anything there to discuss. So I'll flip right over to transactions involving financial instruments. So there are a number of scenarios we'll go through. Okay, when do you recognize at fair value, and then when do you recognize using other bases of recognition? So the first scenario is financial instruments that are recognized at fair value. So the standard is pretty detailed about this. There are 4 types of instruments really that you'd measure at fair value at initial recognition. So this would be equity instruments with an active market. So they have a publicly quoted market price. Debt instruments, you know, think bonds that are quoted in the active market, or debt instruments with fair value inputs that are directly observable. So, you know, some variable rate debt instruments would come under this umbrella. And derivative contracts. So, you know, if you're you know, a contract to purchase foreign currency forward, interest rate swaps, that kind of thing. Okay, so moving down, the next tier here, you'd recognize financial instruments at cost, the cost base being the undiscounted cash flows of the financial instrument. So what would fall into this is, if it's an instrument, it's not required to be recognized at fair value. So it's none of the instruments we talked about above. They're not retractable or mandatorily redeemable shares. And the instrument has repayment terms. So some common examples of this would be trade receivables or payables, notes and loans, payable or receivable. Okay, moving down. So if you don't fall into any of those 2 above categories, you'd recognize at cost, the cost base being the consideration transferred at an exchange amount. So this would apply to financial instruments that have no repayment terms. So think common shares, warrants, preferred shares, options. So equity instruments, more or less. So if the consideration has repayment terms, you'd measure the cost using the undiscounted cash flows of the consideration given up. However, if the consideration has no repayment terms and it's not in the normal course of operations, it would have to have, I won't really get into these criteria. However, if it's not in the normal course of operations and has commercial substance, you would use cost at the exchange amount of the transaction. And then moving into scenario 4 here, so if you don't meet any of the above 3 classifications, then you would measure the financial instrument using the carrying amount of what was transferred, so the consideration. So this is lowest on the rung because you know, it makes the least sense from a measurement from a cost basis. So, you know, on initial recognition, you're probably going to have a gain or a loss on recognition, and you'd measure this in net income in the period when the transaction is in the normal course of operations. So, you know, I think of this, there's a little bit more to it, but I think of it as, you know, this is a transaction, you know, that you might transact with an arm's length party. It has a clear business rationale. If it's another type of transaction, you know, it's not in the normal course of operations, it doesn't have commercial substance, then you'd recognize it in the gains or losses in equity. So, you know, an example of this I could think of would be, you know, if you're exchanging, you know, a piece of land for, financial instrument of some kind. That might fall under equity classification. So a few other things to note: transaction costs from such transactions, rather than deferring and amortizing, which you'd typically do in an arm's length transaction, you just include these in net income in the period they're incurred. Also, if there's a contingent portion of a related party financial instrument, so an example of this might be if there's a management earnout involved, you wouldn't recognize the contingent portion. You'd disclose it in the notes to the financial statements. Excuse me. And then you'd remeasure the financial instrument at fair value when the contingency is resolved. So, say it's a management earnout and, certain milestones have been met, et cetera, you would remeasure at that time and include any gain or loss in net income in that period. So there's a flow chart here that more or less goes through everything I just talked about, which might be a handy thing to reference if you're working through these types of transactions. So once you've recognized these transactions, what's the subsequent measurement provisions for them? So generally, it's the same as 3856 for arm's length transactions. I'll go through a few of the differences that are notable. So when you're conducting an impairment test, you would use the undiscounted cash flows of the instrument in determining the recoverable value, where typically you discount the cash flows. And equity instruments, they would be impaired to a value that you would sell them at the date of impairment. So that's another notable change there. So if a related party asset or liability is forgiven, you'd recognize it in net income unless it's not in the normal course of operations. So go back to what we talked about with whether or not something would be deemed in the normal course of operations. If it isn't, then you would recognize that change directly in equity. Replacement or modification of related party financial liability, you'd recognize it as an extinguishment and then a recognition of the replacement liability, and it would follow the same rubric when you're dealing with, okay, what do you do with the gains or losses? There's some instances where you would discontinue fair value measurement. So if you're looking at an equity instrument that has a quoted market price, you begin to measure it at cost if the instrument's delisted. And so the cost base would just be the fair value right before it's delisted. And you can elect for debt instruments to measure at fair value when certain criteria are met as well. So for hybrid financial instruments, this is an area that's simplified. So, think convertible debt. There's a liability and an equity component to the financial instrument. You can elect to measure the equity component at zero value and allocate all of the proceeds to the liability component. Otherwise, you can measure the liability component at the undiscounted cash flows. Again, we're dealing with undiscounted cash flows, not discounted, and the residual value would go to the equity component. So similar to a residual value method. So there's some transitional provisions to provide relief from doing full retrospective restatement. I won't go into that in a great amount of detail, but there's some information on the slides that will be provided after the presentation, and we'll be including a more fulsome written document on this to provide some guidance on how to apply that. So the third amendment here we'll be discussing that hits year ends ending December 31, 2021 is an update to the income tax section. So this is pretty limited in scope. It's only going to affect entities that use the future income taxes method. there are really two changes here that are kind of surface level. One is that, previous to this amendment, if you have future income tax assets or liabilities that you're recognizing, you'd present them as current or non-current, depending on when you realize the asset, or if it's a liability, when you expect the liability to be discharged. So what the Accounting Standards Board has said is that's too complex a determination. It's full of estimates. So let's just simplify it. US GAAP has done the same thing. So let's just classify everything as non-current to save people the headache. The other change in here is that now entities are required in their disclosures to show separate temporary differences, to show which assets or liabilities relate to each class of temporary difference. So there's a bit more disclosure there now. So it's kind of a little bit of a blessing and a curse. So we're now going into topics where the application date is January 1, 2022 for entities with a calendar year end. So these ones we have a little bit more time on. We can look at this year and going into following year ends, rather than being in a crazy rush if we haven't looked at the previous ones to see how those will apply to us. So for the updates to the revenue standard, it's pretty much going to affect all entities that have complex revenue arrangements or revenue arrangements other than sale of goods. There's not a huge change to the guidance on how you would apply the revenue standards to sale of goods. So there's not really any conceptual or principal updates in here. There's just a lot more guidance on how to treat certain revenue arrangements. There's also some application guidance that they've included on how to identify unit of account. I'll go into what exactly that means. That's a fairly new concept. So a few of the areas where there's a lot more disclosure would be around the percentage of completion method, reporting revenue gross or net. Agent versus principal determinations, a little bit more guidance there. Multiple element arrangements, bill and hold arrangements, what you need to meet in order to be able to recognize those in revenue, and upfront or non-refundable fees, how those are treated. So this is, again, a fairly important update, just because in the past, there hasn't been a great deal of guidance in 3400 for complex revenue arrangements. So, issuers would be looking to other sources of GAAP. They'd be looking to US GAAP or IFRS by analogy, or even back to Part 5 standards. So the Accounting Standards Board thought, okay, well, let's include some authoritative guidance in this section so that people don't have to go to those other sources of GAAP that may not necessarily be applicable, because US GAAP and IFRS, they have a different model principally than Aspie. Okay, so identifying the unit of account. So what is a unit of account? A comparable concept for those of you who are familiar with IFRS would be a performance obligation. So it's really the smallest unit you have that would have a differential revenue recognition method, right? So an example, that might be fairly common for software companies is, you have ongoing support for a software platform that you're selling. But then upfront, you have implementation services, right, that are delivered over a shorter period of time. So, one unit of account would be the implementation services, because those are all recognized together on a completed contract basis or percentage of completion basis. And then, you'd have the remaining service component of the contract recognized ratably over the contract period, right? So that's kind of what it means. If you're looking at deliverables, when we're referring to multiple element arrangements, what that is referring to is a distinct deliverable under the contract. So, it'll be something that potentially has economic value on a standalone basis to a customer. So something that you could pick out of the contract. But again, those might be consolidated into a single unit of account if they have a similar method of revenue recognition. So when should a group of contracts be treated as a single contract for revenue recognition purposes? So there's some criteria here. But more or less what it's getting to is that, the services are so closely interrelated and that they don't really have any economic substance on a standalone basis, and they're performed concurrently by the vendor or in a continuous basis. So in essence, it wouldn't make sense to separate those. And so when do deliverables in a revenue contract represent separate units of account? So again, there's a few different criteria here in the standard that you look at, but getting to the meat of it, it's if the deliverables have a standalone economic value to the customer. So looking at multiple element arrangements, so here's one of the areas where there's a bit more guidance now. The allocation can only be performed at the inception of the agreement. You can't go back and reassess the allocation of consideration. And so you would use a standalone selling price, unless, of course, there's no reference for what that price would be. Then you would go to a couple of different methods that are allowable under the standard. So there's an adjusted market assessment approach, and essentially what that means is you look for data points with your competitors in the market. What are their selling prices for a given component? And then, if that isn't feasible, if it's a very specialized service, for instance, you could use an expected cost plus margin approach. So you'd look at what your costs are to deliver those services, add a target margin, and allocate them on that basis. So there are a few key clarifications that were maybe a bit unclear in the pre-amended standards. So one of these things would be how service contracts or long-term contracts are accounted for. So the default is to use a percentage of completion basis, even if it's delivered over a relatively short period of time, unless there's a couple of criteria that you would look at that would bring you out of that method of recognition. So one of them is that there's a single act, so it's relatively straightforward. The vendor performs B and it's done, or the progress towards completion. There's no way to readily measure it. This would be a little bit less common, I would think. But if you meet one of those, then what you would do is you'd move to a completed contract method. So you'd recognize that revenue at a point in time. So again, there's just more guidance in the standard, in the amended standard, around what are the input and output methods you can use for percentage of completion contracts. What are direct costs and indirect costs to be included in this measurement basis? What costs can you include as contract costs? What costs are excluded? That's something that's treated in a fair amount of detail. And there's also additional disclosure that is required by entities that are applying the percentage of completion method. Again, more guidance around gross versus net, how to apply, whether you're acting as a principal or an agent in a given transaction. bill and hold arrangements. So back in part 5, there was some explicit guidance around bill and hold arrangements. That's coming back. Upfront non-refundable fees. So the amendments make clear that you defer and recognize these unless there's some consideration that's given up in exchange for the upfront fees, in which case you can recognize them at a point in time. So again, there's some transitional relief to save you the pain of going through a full retrospective adjustment. Again, I won't go into any detail on this, but suffice to say, there are provisions here so that you can either put the cumulative effect and opening retained earnings in the comparative period or the period in which you apply the amendments. So for percentage of completion contracts, rather, if these are completed during the comparative year or the first year applied, then you're also off the hook. You don't need to go back and do restatements there, as well as multiple element arrangements. If those have run their course, then again, you're off the hook. There's a lot more disclosure required. So I won't go into that, but there's a lot of information on that in the standards themselves. So ASPE 3041 agriculture, this is an entirely new standard under ASPE. So it's a little bit complex whether or not you might be in the scope of this standard. So this applies specifically to agricultural producers. Again, it's not totally clear cut whether or not an entity is an agricultural producer. There's a definition here, but we'll go into some examples of what might not be considered agricultural production that you might otherwise think would be considered agricultural production. So if you're not an agricultural producer, you're not in the scope of this standard. And if you have agricultural products on your balance sheet, you would look to the inventory section or property, plant, and equipment, depending on the type of asset, which is what issuers would have done previous to this standard becoming effective. So a few examples of things that wouldn't be considered agricultural production are forestry, ocean fisheries, hunting and trapping, etc. So the key demarcation here is that if you have an activity where you control the resource, such as farming, so you're cultivating a resource that you're then harvesting, that would typically be considered agricultural production. Whereas if you don't control the resource, so maybe it's managed by the national government, or you just don't have control over it at all, then it wouldn't be considered agricultural production, and so out of scope of the standard entirely. So the standard introduces a couple of different types of assets. So there's biological assets, and then there's agricultural inventories. So a shorthand way of thinking of these would be biological assets would be something that produces agricultural inventories. So an example of this would be, okay, you've got cattle or you've got swine. Those are productive biological assets. You butcher them and you get agricultural inventories, right? And then you further process those, they go to a meat packing plant and you get inventories for consumption by an end user. And so those wouldn't be either. So I'll go through a couple of examples of this that might apply to you or your clients. So wine produced by a vintner. So this wouldn't be considered agricultural inventory. This is an end product. It's an agricultural product that goes through a secondary process, right? So the vines would be a biological asset. Again, they're producing the agricultural inventory. The grapes would be considered agricultural inventory. That's the raw material that you use to make the wine. The same thing you'd apply to caviar. So sturgeon is a biological asset. Roe, so the unprocessed fish eggs, that's agricultural inventory. Caviar is neither. Caviar is inventory. And same with ground beef. So you kind of get the idea how you would apply these asset classifications and what would fall out of scope of the standard. So again, it's a new standard. There are a lot of new concepts that weren't available to you in the inventory or property, plant, and equipment section. This will be quite impactful for agricultural producers writ large, because you're going to have to look at how you recognize and subsequently account for these types of assets. The change was made to result in more consistency because, people weren't quite sure where to look. Is this inventory? Is this property and equipment? So again, people would be looking to other sources of GAAP by analogy to determine how to account for these types of assets and activities. And so just a figure here, 7% of the Canadian economy was agricultural production in 2016. So that's the share of GDP. So it's a fairly substantive part of our economy, and given there wasn't any authoritative guidance in the standards, that was seen as a pretty big gap to be addressed. So let's talk about recognizing biological assets in agricultural inventories. So first step is it has to be an asset, right? So you go back to section 1000, financial statement concepts. I won't go through that. Most people here will be familiar with that. Productive biological assets, those have to meet certain standards. I won't go through these in detail, but again, think about how that interplays with agricultural inventories. The biological asset is essentially the producing asset, and the agricultural inventories, again, there's some more criteria here that go into some detail, but this is the raw product from the biological asset that then will get produced, go through secondary processes to become inventory. So an important point here, agricultural inventories can be reclassified as productive biological assets, but you can't, it doesn't go the other way around. A practical example of this might be, okay, if you harvest some seeds, you resow the seeds then become a productive biological asset, right? Because you've got some kind of a grain that's then producing. When you're measuring agricultural inventories, you've got a policy choice. You can measure them at cost or net realizable value. So in order to measure them at net realizable value, you need to meet a few hurdles. The criteria are here in this slide. So there has to be determinable and realizable market price. So, think of, prices on a commodity exchange. If you're dealing with a commodity, right, that would be a good example. Or like a purchase or sale contract, a price that's dictated there. There need to be predictable costs of disposal. So you need to know what it's going to cost you to retire this asset or get rid of it if it's if it's hazardous, for instance. And the product needs to be available for immediate delivery. Sorry, going back to that second point, cost of disposal would be selling costs and things like that. The third criteria here, so available for immediate delivery. So that would mean that there's no value-added process that needs to be done that would be required for it to be saleable. Okay, so you can apply cost model or NRV model to different classes of agricultural inventories depending on what it is. You just have to apply those consistently between categories. And then, so if you choose the cost method, you have two policy choices. You can record these assets at full cost. So that would be all the direct input costs plus an overhead allocations, variable and fixed overhead, or only on the basis of input costs. So, for farmers that are harvesting crops, these would be things like seed, fertilizer, pesticides, and then the cost of the labor to actually, do the harvesting and sowing and that kind of thing. And so, You would apply cost formulas consistent with the inventory standard that we're probably all familiar with. So, first in, first out, weighted average cost, specific identification, depending on the nature of the asset. You can also use standard costing if it's high volume and actual costs are too difficult to determine. But then, as with the inventory standard, you need to look at what your actual versus standard costs are, and and determine if that's a good estimate on a regular basis. So if you're using the net realizable value model, again, you need to have a verifiable source of the price that you're using to carry the asset. Again, think about commodity exchange prices and NRV. So if there's any changes in NRV during the period, those are recognized in income in the period they occur. Productive biological assets. So these would be measured, akin to property and equipment. I think that's a useful analogy. And they'd be subsequently measured at cost less accumulated amortization. The one glaring caveat here is if the assets are managed on a collective basis, and they're kind of used on an indefinite basis, you consider them indefinite in terms of their life, and you wouldn't amortize them. So a notable example of this, a couple of ones given in the standard, would be a cattle herd or grape producing vines, right? So, if you manage those resources, sorry about that. If you manage those resources appropriately, then they've essentially got an indefinite useful life. Okay, so for impairment, you would look to the existing impairment standard 3063. However, if they're managed on a collective basis, these assets, then you would group them together for purposes of impairment. You wouldn't separate them into individual assets. Okay. So disposal of productive biological assets, if you've got assets that are no longer going to be used, so maybe you're selling the family farm, you would treat those assets similar to assets held for sale, right? So any losses or write-downs to the lower of carrying value and fair value less cost to sell, those would be recognized in the period, and of course you wouldn't amortize those assets once that decision has been made. There's a lot of presentation and disclosure associated with this new standard. I won't go into it in a fair amount of detail, but again, just how to separate those assets and present them on the balance sheet, what's required in terms of the gains and losses, and what hits the income statement. And so a lot of that is in these slides. And so I'll leave that with the audience here if this standard does apply to you. And again, transitional provisions, there is some relief from full retrospective adjustment. And with that, I'll turn it over to my colleague Devin to go over our tax updates.
Thanks, Matt. So we've got our fill of Aspie updates. Now we have a few tax updates. Who says accounting isn't fun? So let me just start here. So here we go. So we've included a few tax topics here that we think are kind of relevant. Just know that a lot of these tax topics are fresh off the press. The information regarding them are fresh off the press. So the information is still new and evolving, so it may change. And we'll get into the first one. So capital property, and specifically the immediate expensing of capital property. So back in April of 2021, Finance introduced some proposed legislation to allow the immediate expensing of certain properties, that being capital properties for Canadian-controlled private corporations, CCPCs. So this is a great opportunity for CCPCs if they are looking to purchase big capital assets or need to purchase big capital assets, because it allows them to essentially expense it right in the year that they purchase it. Now, there are some exceptions or exclusions out of this, this proposed legislation, mainly classes 1 through 6, class 14.1, 17, 47, 49, and 51. And if you aren't one of those people that have memorized those are basically the long-lived assets. So buildings, road work, goodwill, things with LNG, a lot of big, long-lived assets. So those aren't included. These provisions also allow for the suspension of the normal half-year rule for CCA or tax depreciation. So that's a huge benefit. There is a limitation though. The limitation is that you have a cap of $1.5 million per year, and that cap has to be shared amongst your associated group. So not every corporation or company within the group gets to use that. And based on the proposed legislation, this applies to any property that was purchased after April 18th, 2021, and is available for use for before 2024. Now, based on this, you would think that, okay, well, April of 2021, I should be able to potentially claim this immediate expensing on my, say, December 31st year end. Well, that's not necessarily the case. Sorry, I'm just having a bit of trouble with the slides. There we go. So the actual draft of legislation did not come out until February 4th. So basically last week, and there's a consultation period until March 7th. So it is unlikely that CRA is going to allow the claiming of this immediate expensing until a bill is tabled with the House of Commons. So that's kind of the downside. So if we're looking to claim the expense in the year for 2021, April, we may have to go back and amend those tax returns. So just be aware of that. But there is some good news with this new draft legislation. The proposed legislation actually expanded this $1.5 million temporary immediate expensing to unincorporated businesses as well, that are carried on directly by the Canadian resident individual and certain partnerships. However, this new proposal, the one about unincorporated, comes into effect for purchases made after January 1st, 2022. So just be aware of that. It likely won't go retroactive like the April 2021 amounts. And just know that eligible partnerships don't include tiered partnerships. So if you have partnerships that have partnerships as a member, they won't qualify. So next is the CEWS program audits, the fun stuff. So back March 15th, 2020, the federal government introduced the Canadian Emergency Wage Subsidies Program, or CEWS, to assist employers. Now, we're all probably pretty familiar at this point with this program, but just as a quick refresher, the program was essentially providing subsidies to employers that were negatively impacted by COVID and the pandemic in terms of revenues, and encourage these employers to rehire or retain employees during this difficult time. And lots of businesses actually took up the federal government on this offer. So as of January 10th, 2021, there were more than 2.1 million applications, with 99% of them being approved, and nearly $57.8 billion paid out under this program. So with something like that, it sounds too good to be true. And we're, as tax professionals, we were all just waiting for the proverbial shoe to drop on this, and that shoe being CRA auditing them. And this has started to come in. CRA began a small sample audit of CEWS claims back in August of 2020. And then in December of 2021, CRA announced that they are going to look at continuing to review this in the fall of 2021 and likely into 2022. So And we're starting to see these actually come through for, either directly or through our clients. So what does this mean for the taxpayer? If you did make these claims and you did receive CEWS amounts, be on the lookout for these letters coming in the mail. Given the amount of dollars that were paid out and the amount of applications, we suspect CRA to be definitely going aggressive on these. And in general fashion, reviews are CRA reviews have a 30-day turnaround to respond to these letters, and that's from the date of the letter, not when you receive it. So it's really imperative that you be proactive in respond or getting on these. And 30 days sounds like a lot, but with the type of information that they're requesting, this doesn't give you a whole lot of time. So what happens if you can't support this claim or you've determined that you've erred in it? Well, this would result in a clawback of some or all of the CEWS, depending on what the outcome is, as well as interest on the amounts paid. That's kind of the standard. But in case there was serious non-compliance, there is significant penalties. The general one is 25% of the wage subsidy that is applicable. And in the case of situations where there's gross negligence, it's upwards of 50%. So those penalties are quite significant and need to be, you need to take them seriously. What types of information are they looking at? Are CRA asking for? Well, it's quite a laundry list of things, and it will depend on your situation, but some of them are corporate records. So any minute books, governance documents with respect to CEWS, as well as the status of various entities in the group, corporate agreements with intercompany loans and advances to employees. Have you made these? How is that impacting your CEWS claims? 2019 and 2020 revenues, so general ledgers, trial balances, as well as all the supporting documents for how you computed that qualifying revenue. And then, of course, general payroll information, so payroll journals, gross CPP, EI, and tax calculations, SINs of employees, details about their payments, so timesheets for hourly employees, and work details for salary employees. There's a laundry list there that they can be asking. Bank statements is another one. So it's quite significant. They may even ask for details with respect to other subsidies that you've claimed that may impact your CEWS claims. So what's the big takeaways of this? It's one of the things that these are kind of inevitable. So just be aware that you might get one of these letters, and that's because CRA is going to be aggressive on this. It's likely that they're going to be aggressive and wanting claiming some of that $58 billion back, and definitely be prepared to defend your position. Also, don't delay. That I stress that enough. Don't delay in addressing this, and it doesn't mean respond immediately. We definitely want to get our ducks in a row before we respond to CRA, but don't wait on beginning the compiling of that information. Ensure you retain all the books and records that support this. Don't have them shuffled away into your back storage. Make sure that you have them and ready to go. And this is a shameless plug, but seek out your trusted professional advisor. We deal with CRA all the time, and we may even help with your CEWS claim. So we will definitely be able to assist with that. And the final topic that we're going to be talking about is the new trust reporting rules. We've included these in here just because we know that a lot of our business structures have trusts in place. So it's important that you know this. So for the new trust rules, we have to go way back to 2018, pre-COVID, the great times. And in the 2018 budget, this year, the finance introduced these new reporting rules as a means to combat avoidance tax policies or procedures. So the idea was these new trust reporting rules were meant to be coming in December 31st, 2021. So the trust reporting as of this year. However, we just received 3 days ago the draft legislation for this, and in it it says that this would be effective for year ends December 31st, 2022. So essentially we get an extra year. But essentially what is these new reporting rules? Well, the new reporting rules really focus on identifying all the trustees, the beneficiaries, and the settlers of the trust, as well as anyone that can be appointed. So names, addresses, and SINs of all these individuals, which can be kind of a bit of a difficulty to get if you have situations where a settler has passed away or you're no longer in contact. So it may take time to get. There are definitely, you also have to consider that some inactive trusts or dormant trusts that you haven't been filing will now have to report under these new rules. So definitely drag up your org charts to make sure that you are aware of all the trusts that are in place, and ask your professional whether or not you need to report, because there are penalties upwards of $2,500 per return, or if there is gross negligence, 5% of the trust assets. So, and it also includes in the draft legislation, bare trusts and arrangements are also included now. So something to be conscious of if you do have bare trust arrangements in there. There are some exceptions. I won't go through them, but there are definitely some exceptions. Go through that list when you get these slides. And if you have any questions, certainly ask us. So the takeaways, don't wait to compile this. We're in the reporting period for trust right now, so might as well start grabbing it. Look over your corporate structure. Make sure that there aren't any inactive or dormant trusts that you're not reporting, and maybe drag them out and start asking. And even consider winding up some of these trusts that may no longer be useful or redundant. Kind of it's time to clean these up. And again, seek out advice from us. And I know I went through that pretty quickly, but if you have any questions, I'm here to answer them.
Fantastic. That's great. Thanks, Devin. Thank you, Matt. I do want to be conscious of time. We've run a little bit over, so if guests can't stay on, the recording will be sent to you tomorrow when we get this all wrapped up, so you can fast forward. Matt, you can stop sharing your screen there. That'd be great. We do have a question though. This was going to be, I'm going to say for you, Devin, what class of CCA is the amount immediately expensed should be entered in T2 S8? Oh, you're still muted.
I'm just reading it. Okay.
Yeah.
So what class of CCA is the amount immediately expensed should be entered on the T2 Schedule 8? That is a good question. We're not entirely sure right now if it will be in there. When this originally came out, our tax prep programs actually had a spot where it was immediately expensed, and there was a line item. But because CRA kind of backtracked and said, hey, you're not allowed to claim this yet, they removed that. So we're still waiting to see how it's going to come up. But I would suspect each class will have a specific line on the Schedule 8 that would say immediate expensing, or it may be on a completely different schedule. We're not totally sure.
Okay. One on capital property. If my business does not have 1.5 million purchases in 1 year, but has 2 million in a subsequent year, can I use the unused amount from the prior year against the 2 million?
Oh, that's a great question. No, the 1.5 isn't a carry forward balance. It's not a pool that carries forward. So you essentially get it per year. And if you don't use it, you lose it. So you can't bring it forward. So just be aware of that.
Okay, I've got one on ROMRS. That's for you, Matt. So what is your experience with lenders accommodating amendments to financial covenants with respect to the changes to ROMRS accounting? Oh, we can't hear you. There you go.
Having my mic down by my mouth, that would help. So that's a good question. I've only been through a few of those, but typically, especially if you approach lenders proactively and say, hey, this is how our accounting is going to change. It's going to impact our balance sheet such that they'll be quite open to, amending those financial covenants. So, excluding preferred shares, knowing that in substance, they're still preferred shares. It's just that the accounting rules have changed. What I've also seen is, lenders will issue a waiver. If there's not time to paper an amendment, or they want to sit on it and consider it. Sometimes you'll get a waiver from say a debt to equity covenant for the period that the changes have come into effect.
Okay, great. One more here. With respect, I'm going to say, Matt, this is probably you as well. With respect to the new revenue guidance, what is the difference between a deliverable and a unit of account?
Great. So yeah, I went over this in a little bit of detail in the presentation. So a unit of account could be a collection of deliverables. So if the deliverables have a consistent method of revenue recognition, then those would be grouped into a unit of account. So it would be a larger structure. So it could comprise multiple deliverables. Deliverables aren't necessarily an accounting concept, but would be considered, separate economic units. So you might have a contract that, promises a number of things. Those could be considered separate deliverables.
Okay. Devin, looking at new trust reporting rules, for trusts that have not previously been filed in the past due to being inactive, do I now have to go back and file all the previous tax returns? And if I do, will penalties apply to the previous years?
Great question. We don't believe so, because based on the draft legislation, this is going forward from December 31st, 2022. So you would file this on a going forward basis. We've had situations in the past where a trust has been dormant and then had to file for whatever reason, and they did, and then CRA has sent a request for all the previous ones, and all we did was submit a letter saying that it was inactive, and as such we hadn't filed for it. So I don't believe that there will be any penalties associated with that, because this is it's not a retroactive applying legislation. It's going on a going forward basis, but we're still in the early stages, so we don't know how this will all fall out once the consultation is done and it's been drafted. So stay tuned.
Perfect. And I have one more, and we're going to wrap it up. Matt, where can I find more resources on application of the new guidance?
That's a great question. So again, we'll have these slides available with a little bit more detail as a separate document. I'd encourage you to go straight to the actual standards themselves. In the appendices to the revisions of the standards, there are a lot of flowcharts. I didn't have them all up on my slides. And again, CPA Canada, they have good interpretive guidance and thought pieces that will highlight what exactly the changes are and how those are relevant.
Perfect. Okay.
Yeah, and just to follow up, we did have to go through that a little bit quickly. So obviously we have more information in the slides there than we discussed. But if you do have any questions, you definitely reach out to either me or Matt, because we're happy to help.
Yes, and in the follow-up email that all of you have received after attending, we'll have that out tomorrow. Matt and Devin's information will be in there if you'd like to connect with them, or your partner that you have at your local Crowe office as well would be able to help you. So with that being said, we did run over. Thank you everyone for who stayed on. Thank you so much for attending. We hope to see you at our next webinar soon. And that one is on intellectual property, and that's on Tuesday, February 15th. That will also be an invite in that email tomorrow. So if you are interested, we look forward to seeing you there. Thank you everyone, and enjoy the rest of your afternoon.
Take care.
Bye.